This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the final lecture on cash management, chapter 6 of the free lecture notes. And in this lecture, I want to explain the Miller Orr model, which there can be some calculations which I'll come to, but more important is understanding what the idea is. And I think you'll agree the idea is, I think, very sensible. What it is this, that obviously from day to day, my cash balance will keep changing. You know, some days I receive a lot of money from receivables, the cash balance gets very high. Other days, I'm paying a lot of expenses and the cash balance gets very low. Now, we already know we don't want too high a cash balance. If I happen to have surplus cash this week, it would make sense to put it on short-term deposit and be earning some interest. But then other weeks, I'm getting lower cash, I'll take the cash back. And the sort of way it works is this. If I did a graph over time, I'll do cash budgets and I think, oh, maybe on average, or to be safe, I need 10,000 in the bank. So I might start with 10,000. And maybe over the next few days or weeks, I'm receiving lots of cash and the balance is going up. Well, I've already said we don't want too much cash in the current account. It's wasting money. Put it on deposit. So I'll set myself an upper limit. I might say, oh, if ever it gets as high as 18,000. I'm making up figures here. But if ever it gets as high as 18,000, then I'll put money on deposit. So it's gone to 18,000. What I'll do is I'll put 8,000 on deposit. And the balance, so that the balance goes back to 10,000. And so I'm earning some interest. And maybe over the following few weeks I carry on receiving more money and it carries on going up again. But again, as soon as it hits this limit I've put on it of 18,000, again, we'll put 8,000 on deposit. It goes back down to 10 and I've now 16,000 on deposit. However, maybe the next few weeks I've got a lot of expenses and the cash balance starts falling. Well, fine, I don't mind it falling a bit, but I'll set a bottom limit. Talk about how I might set my limits later, but suppose I've set a bottom limit of 7,000. Because, you know, I daren't let it drop below 7. I've done my cash budgets and I reckon we've got to have at least 7 all the time. And so as soon as it drops to 7, then I'll take money back from deposit. I'll take 3,000 from deposit. So that it goes back to 10,000. And we carry on like that. I set these limits. If ever it hits 18,000, I put on deposit to go back to 10. If ever it gets as low as 7,000, I take back from deposit. Again, it goes back to 10. So I'm forever putting on deposit and taking away, which of course these days with internet banking is easy enough. You know, almost every day you could put money on deposit or take money off deposit. And in that way, you're making the best use of the money. You are earning interest. Those limits, for very obvious reasons, the 18,000 in my example we'd call the upper limit, The 7,000 we call the lower limit. And finally, the 10,000 in my example, we call the return point. So that's what Miller Orr is suggesting, and I say again, I think that is very sensible indeed. However, they went further, suggesting how we went about calculating these upper and lower limits and the return point. First of all, the lower limit there's no formula for it. It depends on the business having done their cash budgets. The lower limit is the absolute minimum they dare operate with. So that is decided by the business There's no rule. I say every company is different. I'm a very small company. Perhaps my lower limit is just 1,000 or 2,000. A huge company, they may set a lower limit at 50,000 or something. It's whatever from their budgets they think they need, the minimum they dare have to keep operating. And that would be given you in the exam. If there are any numbers, you would be told what the lower limit is. As far as the upper limit's concerned, the upper limit is the lower limit, which again you would be told, plus what we call the spread. And for the spread, there is a formula for, and I've typed it just above example 3. The spread is this formula: 3 times 3/4 times transaction cost times variance of cash flows divided by the interest rate to the power 1/3. Now, I'll explain what each of those terms means in a moment. You can see quite a messy formula. That formula, though, is given in the exam. I'll show you how we calculate what those figures mean in a minute with the example. But lower limit, you'll be told. In practice, it's up to the company to decide. Upper limit, you calculate the spread using the formula, you add it to the lower limit. And finally, the return point. Again, I've typed it out there, but it's the lower limit, which again you'll be given, plus 1/3 of the spread. And again, you are given that formula in the exam. So these two you're given. You just need to be able to use them. The lower limit will be given in the question. The only extra bit you need to remember is the upper limit, lower limit plus the spread. So let's have a look. Look at example 3. A company has decided it needs a minimum balance of 10,000. So straight away, that is the lower limit. The transaction cost of making transfers to and from deposit is $5. So that's what we're talking about in the formula. Every time you move to or from deposit, there's likely to be a cost involved. Well, in the formula, it's the transaction cost each time, which in our example is $5. The standard deviation of cash flows is 2,000 per day. Now, this is very annoying because although some of you at school or at university may have heard of the standard deviation, in paper F9, and in fact in paper P4, the follow-on paper, you cannot be expected to calculate a standard deviation. And me to explain now really would be wasting your time. Basically, what it's measuring is obviously your cash flows, we've already said, will change from day to day. You know, think back to my graphs. Sometimes they get higher, sometimes they get lower. The standard deviation measures the extent of how much higher and lower they get. So you see, if my cash was always about 10,000 and only went up and down a little bit, the standard deviation would be very low. If, on the other hand, my cash on average is 10,000, but sometimes it's a lot higher and sometimes a lot lower, the standard deviation is a lot higher. But again, calculating it is not in the syllabus. If he does ask this, you would be given it. However, and this is even more annoying, the formula has variance in it. Well, the variance, and this, if you want to be safe, you'd better learn, the variance is the standard deviation squared. Now, that isn't given. It's very annoying that the examiner, you know, variance standard deviations aren't in the syllabus. They're not mentioned anywhere else in paper F9. And you're not required to calculate them. It's just very annoying, therefore, that he expects you to know that the variance is standard deviation squared. He's only asked the numbers in this way once. So whether he does it again like this remains to be seen. In other questions, he's actually made it a bit easier for you. You do not actually need to learn to use the formula. However, to be safe, learn that, and certainly learn that. That has been tested on. And to be safe, learn that, even if that's only been relevant once. Finally, the interest rate is 5.11% per annum. 0.0, if you divide by 365, it's 0.014% per day. This is the exact question the examiner asked. If he does it like this again, if he gives you standard deviation per day, he will give you the interest rate per day. This is exactly how he set it in the exam. You wouldn't be expected to calculate yourself the daily interest rate. Having said that, now let's stick all those figures in, the formula for the spread. The spread is 3 times 3/4 times the transaction cost. As I said a few minutes ago in example 3, it's $5 per transaction times the variance of the cash flows. And again, as I said a minute ago, the variance is the standard deviation squared. So times 2,000 squared divided by the interest rate per day. Now here, be very careful. You should already be aware from earlier lectures, 1% is the same as 0.01. 0.01 is 1%. 0.1% is 0.001. 0.01% is a tenth of that. It's 0.0001. Now, the reason I'm saying that is here the interest rate, 5.11% a year. The daily rate is 0.014%. So just as 0.01% is the same as 0.0001, 0.014% is the same as 0.00014. Finally, it's to the power 1/3. And how you do this is up to you. With a scientific calculator, taking something to the power 1/3 should be easy enough. But you should, I think, be clear from school that something to the power 1/3 is the same as the cubed root of the number. So when you're doing this on your calculator, in a minute, obviously, we've got to work out all of this bit. When you come to do it to the power 1/3, either use an x to the power y button on your calculator, 1/3, or with a scientific calculator, you should have a button like that to get the cubed root directly. It doesn't matter, they're both the same. Anyway, let's do it. The bit in the brackets, first of all, 3 divided by 4 times 5 times 2000 times 2000, 2000 squared equals, divide by 0.00014 equals a huge number. To the power 1/3, so x to the power y, point 1/3 is 3333333 equals times 3. And I get, and it does take some practice with your calculator, so make sure I get the spread equal to 14,249. 14,250. In fact, I'll call it 14,250. I'm not going to mess around with 1. Now again, you had to do that once in one exam a long time ago. In more recent exams, when it's been asked, he's told you what the spread has been, and you've not actually needed to use the formula. But you are given the formula, he could require you to use it. And so you'd better make sure you can sort it out on your calculator. Having got the spread, it's now easy, because remember we said the lower limit will always be given in the question, and it's 10,000. The upper limit, 10,000 plus the spread. And finally, the return point. The lower limit, 10,000. Remember, this formula is given. The return point, the lower limit, 10,000 plus 1/3 times the spread. Which gives us what? 14,250 divided by 3 is 4,750 plus 10,000. I get 14,750. And there we are. So I'm not going to wind back to my picture at the beginning. But the return point, 14,750, whenever the balance hits the upper limit of 24,250, we put the difference on deposit, so it goes back to 14,750. If ever the balance drops as low as 10,000, we take the difference from deposit to go back to 14,750. So there we are. I think I've said enough about the formula being messy. And again, practice to be safe. But it is these days unlikely you'll need to use it. More importantly is to learn that and you're given that one, it's those two formulae that you're likely to need. If he gives you the spread, you can get the upper limit of the return point. And also appreciate, if he gives you the lower limit and the upper limit, you can calculate the spread because it's the difference between the two. And once you've got the spread, the return point's easy. Okay, so that's it for cash, and that's it for the working capital part of the syllabus.